Good morning from New York City for our viewers worldwide. I'm Matt Miller, in for my good buddy Jonathan Ferro. We're looking at equity indexes, futures that are rising. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Coming up, futures edging higher at the end of a bruising week for investors. The bond rout taking a breather after yields touch multi-decade highs, and the clock is ticking with a shutdown and more strikes on the horizon. We begin with the big issue countdown to 12 p.m. Eastern.
You look at the UAW.
The UAW strike.
The auto strike.
There isn't a deal that's been negotiated.
Potential for the strike going on longer.
What message does it send for wage earnings growth and how sticky wages may be going forward?
What is that going to do to wages across the board for labor?
Higher wages and margin compression.
That's certainly could be inflationary.
The Fed's going to keep a very close eye on that.
It's going to make the Fed's job a lot harder.
Makes the Fed's job even tougher to constrain inflation.
Wage gains is something that, complicates their mandate.
The labor market remains very tight and wage pressures really haven't eased sufficiently.
It's definitely problematic for the soft landing.
The big question for all of us, looking at the economy, looking at the markets, will it have demonstration effects?
We don't know if there's a larger and more prolonged strike, exactly what it would do.
This is unprecedented.
Joining us now to discuss is TPW's Jay Pulaski, as well as Academy's Peter Cheer. Let's start with what to expect from rates going forward. I mean, I would have thought a couple days ago it's a perfect time to buy because they couldn't go any higher, and yet they continued to march higher. Jay, what do you think about rates? Is it a screaming buy?
Well, Matt, great to see you. I think the rate back up here really demonstrates the depth of belief in recession within the bond market. I mean, the way I'm viewing the last couple of days is that the good news is that the Fed is more in line with reality than at any point since COVID struck us back in March of 2020. I was on the program several weeks ago and suggested that the Fed was going to double its 2023 GDP forecast and raise 2024, and that's exactly what they've done. They took down unemployment, and basically they took recession off the table. And from a risk asset point of view, I think the opportunity is much more in equities than in bonds, because essentially what we've done is we've traded a recession call for 2 fewer rate cuts in 2024. And I think that's absolutely a great trade for risk assets. And as I see it, the Fed is now validating what the other cross-asset markets have been suggesting, namely that we're in a bond bear market, that the commodity bull market, commodities are up almost 8% over the past month, validating that, validating the rise in earnings revisions that have been supporting equities and will continue to support equities, and supporting the thesis that the credit market has been telling us, which is that everything is fine. So we're on a hunt for the return to stability, which is going to unlock the $1 trillion that went into the money market funds. And I think we've moved a lot closer to stability, believe it or not, after the last couple of days than we were a week ago.
Peter, don't we have to see at least another hike from the Federal Reserve? Because, as Jonathan was pointing out earlier on surveillance, they have been saying for a long time they believe they're sufficiently restrictive, and yet the economy continues to grow, right? And yet the labor market is still very strong. And we could get more inflation coming out of, obviously, this strike, considering it's looking like it's going to go on a little bit longer. So aren't they going to need to raise rates more to really be restrictive?
I don't think they're actually going to need to do that. I think if you look at the last job report, it was perfect, right? We actually had labor force participation increase. So I think as the data keeps coming in, it is going to give them enough reasons not to do anything, which is what I think they're looking for. Up until recently, they've been looking for excuses to hike. looking for excuses to do nothing. And I think the data is going to come in with that. I think people forget, too, just how good the consumer was and corporations were at locking in long-term yields. They borrowed longer term, even auto loans extended, every part of the borrowing structure extended. So all these rate hikes, it's going to take a year, 2 years, 3 years for it really to start impacting most people. So they are better off leaving this on hold, letting real yields be high. And I think they're starting to get a message, too, a very strong message from small and mid-sized businesses. Enough is enough. Borrowing costs are getting hard for us. It is difficult for us to invest. And I think they're going to listen to that as well.
Peter, I want to drill down on something that you're implying here, that the long and variable lags truly are long. A lot of people have made the argument, including Jan Hatzius from Goldman Sachs, that they aren't really, considering the incredible transparency, the fire hose of information flow that we get, and the fact that nobody has floating rate mortgages anymore. We're all fixed post-financial crisis. Do you really think these lags are still taking 6, 12, 18 months to come through?
Yeah, if anything, I think it takes longer, right? If you had a 3-year on average, you'd already be getting impacted. But people extended to 5 years. Corporations extended out to 8 to 10 years. So it's taking a lot of time for these higher costs to impact stuff. It's affecting some decisions, but it's not affecting current, capital bases. So I do think it's going to take much longer than people realize for this to take. And the people who do have leverage loans, short-term debt that's rolling over, they are starting to feel the pain, and that's where the noise is going to come from. And they're going to say, enough is enough. Let's just hold off and see where this plays out.
Jay, what do you think about the extra dot in the plot? I mean, it was 12 Federal Reserve members who said we're going to need another hike. Are we going to need another hike? And also, does it matter? I've heard so many people say 25 basis points doesn't matter. Does it matter? Because we'll freak out on the day that they do it.
Well, that's natural, right, Matt? But yeah, to me, dot plots mean squat. In other words, the Fed's history of being right on the future is very poor. Guys like us that make a living getting the markets right would be out of business if we had the track record that the Fed has in predicting what the economy is going to do going forward. So I pay virtually no attention to the dot plot, never really have. And my focus, again, we're focused on the return to stability. We're focused here at TPW Advisory on the rate cutting cycle that is underway around the world, Brazil most recently, just yesterday, as opposed to backward-looking rate hiking cycle. We're effectively done, whether or not, to answer your question, they raised 25 basis points or not. The point is that the Fed has validated the higher growth for longer. We're not going back to 2010, 2019, low growth, low inflation, et cetera. We're in a new environment with new industrial policy. Global growth is accelerating and inflecting upward, and that is what we need to see for equities. And I expect as we move into earnings season and we continue to validate 2024 double earnings growth for the S&P, equities are going to do just fine.
All right, everyone piles on the Fed, but I feel like, they may be guiding us right now to a soft landing, which would be pretty admirable. Of course, there's still a massive threat. A few threats, but one I think that towers over the others, and that is the strike. Detroit's Big Three bracing for even more walkouts as a deal with the UAW remains elusive. A week into it, the union's president, Shawn Fain, set to announce the next steps at 10 a.m. Eastern. Bloomberg's Kayleigh Lyons joining us for more. So, Kayleigh, we'll hear the Facebook Live announcement in just about an hour, and then I guess in a couple of hours, that's the deadline that he's set.
Yeah, right. Set for progress in these talks with the big three automakers. And so we'll understand when Fain speaks less than an hour from now exactly how they plan to expand this strike, which to this point, a week into it, has remained relatively narrow in scope. We're just talking 13,000 workers who have walked out of 3 different facilities, one per automaker, a Ford plant in Michigan, a GM one in Missouri, and for Stellantis, one in Ohio, all that make profitable vehicles. And according to S&P Global Mobility, it's affecting output of these automakers in total by around 3,200 vehicles per day. The union, though, intentionally left room open to begin inflicting more pain if necessary, if they couldn't get closer to agreement with these car makers. And that's where we find ourselves now. Of course, the union continues to ask for a 36% wage increase over the course of a 4-year contract. All three automakers remain instead right around the 20% mark. So there's still a lot of daylight there, but that really isn't the only issue. Take Stellantis, for example. Union negotiators have said just some of their most important issues aren't being addressed, including the issue of job security, given the potential closing of a number of Stellantis facilities. There's also the wider question of the role of workers in the EV transition. That's one of the complicating factors here in Washington for President Biden, who has pushed that EV agenda, but also is trying to be the most pro-union president, he says, in history. He has still been on the side of the UAW. He says record contracts for automakers should mean record contracts for record profits, rather, for automakers should mean record contracts for auto workers. And yet we're still trying to figure out the contract details. And the longer this goes on, Matt, the more pain theoretically it could inflict on the economy. If we see this strike expand to all 150,000 UAW workers, for example, that could affect about a third of the auto production here in the U.S. And remember, the auto sector is about 3% of GDP.
Yeah, it's, I think, a fascinating set of negotiations here. I mean, Dodge and Chrysler don't even have really any products announced for next year. They've shown us a Banshee concept, but nothing since then. And this could amount to a real wage price spiral if it gets out of control in the other direction. Kayleigh, how worried are people in Washington about this in terms of its effect on inflation or the slowdown of the economy?
Well, they're always worried, Matt, about inflation here in Washington. That said, at least on the left side of the political spectrum, including in the White House, there is a conversation happening ongoing about how much profit corporations are raking in and how that should be translated to workers. If you are pro-union, which many Democratic lawmakers are, they would like to see the UAW workers getting more money here. There's even some Republicans who are saying that, like J.D. Vance, the senator from Ohio, where you herald from, Matt, who have said that the UAW should be using its leverage here in order to potentially disrupt the EV transition. That said, elsewhere here in Washington at the Federal Reserve, of course, they are watching this very closely. When we talk about 150,000 workers, we are talking about a very small fraction of the American workforce. So theoretically, it wouldn't necessarily expand elsewhere, but it just speaks to this dynamic where employees are still feeling like they can ask for more money, and if they get it, that could refuel inflation.
Sure. If you're at a supplier or another automaker, even if you're not a union worker, you're going to look at them and say, I want that.
Yeah.
Also, we call it the great state of Ohio, Kayleigh, because 8 presidents call Ohio home.
Of course.
Thanks very much. Kayleigh Lines there in Washington, D.C. Joining us now with a look at what's going on in the stock market ahead of the opening bell. Let's bring in Abigail Doolittle. Abby, what are you looking at?
Well, Matt, we are looking at a little bit of a relief pop for U.S. equity futures overall, with the S&P 500 right now up about 0.3% after a 3-day slide. Yesterday, the worst day for the S&P 500 on that hawkish Fed pause going back to March. But today you can see Amazon getting a nice boost, up 1.4%. This as they are saying that their Prime Video content will include ads starting next year. Activision Blizzard up nearly 2%. The deal with Microsoft is set to clear the final UK hurdle. And then ExxonMobil, just to broaden it out a little bit, we do have WTI crude still above $90 per barrel, up about 0.9%. And Morgan Stanley is maintaining their overweight on the shares. They've also raised their price target to $131. Not so bad. Again, a little bit of a bullish tilt for stocks this morning.
All right, Abby, thanks very much for that. Peter Cheer and Jay Pulaski are going to be rejoining us. I'm going to ask them what they think about the strike, as well as the shutdown. Time is running out on Capitol Hill.
Kevin McCarthy, on the other hand, doesn't play this right, could be subject to a sort of oust the speaker movement. And if that happens, then we have chaos. Then the shutdown could last a lot longer. And that's the nightmare scenario.
Government shutdown conversation still ahead. This is Bloomberg.
Well, there are two scenarios, I think, right now that we're looking at. One is that the shutdown, lasts a little while and then people come to the table and they resolve it because, there are probably 150 votes in the Republican Party that want to see the government stay open. Kevin McCarthy, on the other hand, doesn't play this right, could be subject to a sort of oust the speaker movement. And if that happens, then we have chaos. Then the shutdown could last a lot longer. And that's the nightmare scenario.
A growing risk of a U.S. government shutdown with just 9 days left to make a deal, splintering within the Republican Party, still causing massive problems. Speaker McCarthy's defense spending bill blocked on the House floor for a third time by a pair of ultra-conservatives.
Two people flipped, so I got to figure out how to fix that.
Did you know that they were going to flip before the vote?
No, that wasn't the impression they had given.
Representative Marjorie Taylor Greene, one of the GOP dissidents, suggesting McCarthy shouldn't have been surprised by her vote.
I've told him everything that I've told everybody else. I'm completely transparent in every conversation I have. We should have been passing our appropriation bills back in August.
Bloomberg's Anne-Marie Horder joins us now for more on, is it fair to call this an absolute mess?
It is a mess, and we are looking like it's looking ever more likely that we will have a shutdown. And I think you could see the division there just from hearing Speaker McCarthy and Marjorie Taylor Greene. Marjorie Taylor Greene voted no on a rule yesterday. That rule would allow a debate on a defense bill, not even a vote for or against the bill, just the debate on the defense bill, because it took in and included Ukraine aid. This is what she said to Kayleigh Lyons yesterday. Kayleigh was up at the Hill. That is one part, Matt, of the GOP caucus. On the other hand, you have a congressman like Mr. Lawler. This is a New York congressman. He's from a Biden district, and he wants to see a vote next week on a continuing resolution. And if he doesn't see one, he says he may have a discharge position, which means he can work with Democrats, put one on the floor that would go over Speaker Kevin McCarthy's head. So this is what Kevin McCarthy is dealing with in terms of some of the individuals in his party and how far apart they are. And that gap just at this moment does not seem to be narrowing.
Does at some point McCarthy himself have to choose between being the speaker and getting absolutely nothing done or governing and getting the boot?
Well, the thing is, if he governs and gets the boot, this will be even more chaos. Then who comes next in this position? What you're seeing is because he is dealing with very, very slim majority. And actually, that majority actually got even slimmer because there is a congressman who retired recently. You have some individuals who are out because of medical reasons as well. So this is going very difficult for Kevin McCarthy. And what you see him try to do is what we saw during the debt ceiling debacle, which is try to get some leverage from the hard right, put that on the floor, and see if that works when he's dealing with Schumer or the White House. But at this moment, he's not even able to get the hard right bill of a continuing resolution on the floor. If he does work with the Democrats, that means he's likely going to face a motion to vacate.
All right, Anne-Marie, thanks very much. Anne-Marie Horder here in New York for UNGA, talking to us about the government shutdown as well, which I think it's safe to say is almost inevitable. Jay Pulaski and Peter Cheer are back with us. Peter, what's your take on the shutdown and how much it matters maybe relative to the UAW strike?
For me, both are fairly back order type effects. If the shutdown lasts months or something, maybe it's a problem. If we get it in a week, I don't see a big deal. I think the auto worker strike is potentially a risk. Again, that will take time to see how it plays out. When I'm sitting here trying to look at the world, and what I want to figure out over the weekend and the coming weeks is, we're going to see some AI success stories. I really want to figure out, are companies going to be able to start demonstrating, hey, we've used AI and we've seen these great efficiencies? Because I think that would be much more important to the market than anything that's going on with either the government or right now even the auto strike. And I'm looking at the IPO market, right? We've started to see some enthusiasm for IPOs. It's been mixed results. Do we get one of those pops where all of a sudden you start seeing companies, you start seeing acquisitions, maybe like Cisco did yesterday, and really that drive the market? So in my, scheme of things, that's what I'm looking for, and those other issues right now are kind of taking the back seat.
Jay, what do you think? I mean, a lot of economists have been telling me the UAW strike could be a real problem going forward because if it goes on for a long time, that's going to mean big inflation for cars and a slowdown in GDP. If they get a serious wage hike, then everybody else is going to want that too, and that drives up the pay.
Well, I think, first of all, Matt, D.C. is a clown show, right? And it has been for a long time, and I think markets are not going to be surprised by that. As far as the UAW, I expect it to be resolved reasonably quickly. There's plenty of money to go around. Profits in car makers have been significant over the last couple of years and likely to continue to be so. Here at TPW Advisory, we're focused on 4 signposts to the road to stability. And the first is continued disinflation in the US and Europe. The second is a incipient global manufacturing recovery as we shift from inventory destocking to restocking. The third is continued upward revisions of earnings. And the fourth is policy traction in China. We're very focused on the opportunity set there. As long as China starts to gain traction, which we expect to be the case over the next quarter or two, we think the global economy is going to be fine. And look, we continue to be focused on opportunities outside the U.S., particularly in emerging markets and in commodities. And I think the U.S. is going to be fine, risk assets, because earnings are going to be fine. And that's all that really matters at the end of the day.
Peter, we just got 30 seconds here, but you know, there's a list of headwinds I don't even have to go through anymore because we all know them so well. Are you as bullish the global economy?
No, definitely not. I think China, to the extent they are going to see growth, it's going to be by them selling their products into emerging markets countries. So I think that's a risk for U.S. companies that sell into emerging markets. I do think India is really interesting. I think India, I'm trying to figure out the right way to play it. I expect really good growth out of there. And the one thing I'm worried about in terms of a commodity super cycle is India getting its story correct between space, between AI, between infrastructure, between onshoring or reshoring that's going on in India. If they take off, I think we could see a 2006 to 2008 type commodity super cycle. And it seems to me that sort of inflation is the U.S. Achilles heel. So that's something in my background as a real potential headwind, not today's problem, but maybe next year's.
All right, Peter, great to get some time with you. Peter Cheer there from Academy. Jay Pulaski, always good talking to you from TPW Advisors. Coming up, the morning calls, and then later, big tech falling victim to surging bond yields. Mona Mahajan of Edward Jones joins us at the opening bell, revealing her higher for longer playbook. That conversation still ahead. This is Bloomberg. This is the countdown to the open. I'm Matt Miller in for Jonathan Ferro. After the big drop that we saw yesterday, off 1.6% on the S&P, the first time we dropped below 1.5% for over 101 days, we're looking at futures that are bouncing ahead of the open. Let's get to the morning calls right now. First up, Wells Fargo upgrading Charter to an overweight, expecting growth to reaccelerate due to new mobile and video initiatives. Next up, Canaccord downgrading Deere to a hold, citing slowing growth for large agricultural equipment and normalizing dealer inventories. And finally, Bernstein upgrading Wayfair to a market perform, pointing to improving revenue growth and management's positive messaging on margins. Coming up, big tech set to rebound as Treasury yields fall from multi-year highs. That conversation up next, as well as the open. Mona Mahajan of Edward Jones joins us. This is Bloomberg. This is the countdown to the open. I'm Matt Miller in for Jonathan Ferro. Moments away from the start of trading, we see futures up across the board after the big drop that we had in the live trade, in the cash trade yesterday, and after yields came back down a little bit, giving tech shares a little bit of room to breathe. There you hear the opening bell, and you can see it there on the New York Stock Exchange and here on the NASDAQ. Let's switch up the boards and take a look at some of the other asset classes that we pay attention to. The euro dollar, 106.48 right now. Not a lot of change there. The 10-year yield also little changed, but still at a relatively high level, 447.63. And NYMEX crude back up above $90 a barrel after having dropped below that benchmark price yesterday. 91.13 the level for West Texas Intermediate. Now, one stock to watch at the open this morning has got to be Activision. Microsoft is closing in on its $69 billion acquisition after passing a final regulatory hurdle in the UK. Microsoft executive Brad Smith saying, quote, "We're encouraged by this positive development in the Competitions and Markets Authority's review process." Ed Ludlow is here with more on this big deal. Ed?
It's astonishing because at the beginning of the summer, anyone you would talk to would say this deal wasn't going to happen. Now, look at Activision shares, $94.10, 90 cents away from the $95 per share offer that Microsoft made. This is a $69 billion deal. The compromise that Microsoft and Activision put on the table was to sell the cloud streaming gaming rights to Ubisoft, a French independent video games studio and publisher. And from the CMA's perspective, the Competition and Markets Authority, that is good enough to maintain a competitive market to their mind. It's interesting because basically Microsoft and Activision went to regulators, the CMA being the final hurdle, saying, the cloud market is a tiny nascent part of the video games industry. Why are you so hung up on this? But it's what they wanted to see. And Sarah Cardle, the CEO of the CMA, was on our programs earlier this morning saying, this is a lesson learned. Next time would have been easier if you guys had just done this compromise to begin with. There is a consultation period through October 6th. But right now, based on the spread and all of the reaction to this CMA provisional decision, this deal is going through, and it's a big one for the video games industry.
Yeah, a big one for people who care about Call of Duty as well. Ed, thanks very much for that. Some breaking news right now on Ford. We see the shares also popping in the pre-market. Let's get over to Abigail Doolittle with the details. Abigail?
Yeah, indeed, Matt. We do have the shares of Ford popping higher right now, up about 2.5%. The best day since early June. And this on a Reuters headline that the UAW is to announce progress made with Ford in labor talks. And of course, at 10 a.m., the UAW is expected to ramp up this very particular strike that they're doing, surgical strike that they're doing. But now we do, of course, have this headline that UAW has announced progress made with Ford in labor talks. The shares are higher, up 2.3%. We also have a sympathy trade in the shares of GM. They are also higher, so we'll be waiting for more here. But the idea, quote unquote, real progress has been made by the UAW with Ford. So it will be interesting again to see what announcements could potentially follow this, and if it also is a good sign for both GM and Stellantis. One other stock that is moving this morning, of course, Matt, is Amazon. This after the company has said that they, similar to Disney Plus and Disney ESPN and Hulu and some of those other streaming services, along with Netflix, they are going to be running ads on Prime Video in key markets starting in 2024. And of course, right now, Prime on a yearly basis costs $139. The cost to not have those streaming ads, $299 a month, which is less than Disney. I believe it's also less than Netflix. But these major streaming services, they are trying to bring ads into the service and then get people to pay extra to not have to have that. And just to return quickly, Matt, because you are a car guy, Ford right now at session highs up 3.4%, the best day again, I believe, since early June. And on this Reuters headline that the UAW head saying that real progress has been made, and we also have now CNBC reporting on that in addition to Reuters.
Yeah, it's interesting. Usually the UAW gets along with Ford best. The workers like that the company is essentially family owned, or, you know, in a sense, and that Bill Ford gets personally involved in those negotiations. So typically they're friendlier. On the other hand, it hasn't looked like that over the past couple of weeks. We'll continue to follow these developments very closely. Abigail, thanks very much for that. Now, a big day for Apple. The new iPhone 15 going on sale in roughly 40 countries today. Dan Ives of Wedbush writing, quote, iPhone 15 pre-orders are still tracking much stronger than we and the street originally expected, and up roughly 10 to 12% from iPhone 14 based on our analysis. Katie Greifeld is here with the latest. Katie, did you get yours yet?
I haven't gotten mine yet, and apparently online reservations are hard to come by as well. But you take a look at shares this morning, up slightly as the iPhone 15 Pro and Pro Max models go on sale in this first wave. And Matt, there's at least two big tests here. The first one, of course, is what demand will look like for the new iPhone 15. And also, can Apple fulfill that demand? Now, at least on the first point, there's plenty of early signs that indicate that people definitely want to buy this new phone. You take a look at new online orders for the highest end new models, and they won't arrive for customers at least until mid-November in several countries, rather. And while reservations for in-store pickups, they actually quickly sold out. So a lot of early indications of demand, and that's good news for Apple because there is a lot riding on this. These models will represent Apple's biggest sellers through the end of 2023 and are expected to make or break Apple's holiday season. Obviously very important for the iPhone maker. It's hoping to return to growth after a streak of quarterly sales decline, Matt.
All right, we'll be watching that. I saw lines outside the Apple store on Fifth Avenue driving in this morning already. Katie, thanks very much for that. Mega cap tech stocks flirting with one of their worst weeks of a pretty good year. Surging bond yields have kept pressure on some of the sector's biggest names. Mona Mahajan at Edward Jones weighing in, writing, quote, "We expect some broadening in leadership as rates remain elevated and would look to complement growth in tech stocks with better valuation parts of the market. Cyclicals and over time, small caps may play some catch up." I'm pleased to say Mona Mahajan joins us now with more. Mona, great to have you on the program. I didn't see the word value there. Certainly not, describing that group of stocks. It's almost become a dirty word in this market because it doesn't seem to ever win out. What's the story?
Yeah, thanks, Matt. Look, I think a lot of the sectors that were mentioned there are part of the value complex. So to broaden it out to value more broadly, I think probably would also include some of the defensive parts of the market like healthcare, staples, and utilities, which tend to outperform in periods of a recession. And clearly, this economy has held up too well to pile into defensive parts of the market. So we want to be really particular in what we're looking at if we do expect a broadening of market participation. And this is really for the quarters ahead as we head towards 2024. That is really an environment where we see the Fed potentially pausing and, as they've indicated, maybe pivoting lower. We see inflation continuing to moderate, and we could get a rebound in earnings growth as well. So that's a better backdrop for a balanced portfolio. Now, we wouldn't want to wholesale get out of the AI tech story. We think that's in early phases of a secular bull market as well. But we certainly think, given what's happened this year particularly, some broadening of participation, especially if we reemerge from some sort of period of economic softness, does make a lot of sense. We want to make sure portfolios are balanced, diversified, and have exposure to those cyclical and potentially small caps as well.
What are the cyclicals? I mean, do you like the automakers right now? It seems like a tricky situation.
Yeah, I think we have some headwinds ahead of us that not only with the UAW strike, of course, we have a potential government shutdown. We have oil prices that remain elevated, walls of worry that the market will have to continue to climb. But markets have looked forward in the past. They will continue to do so. So within the cyclical complex, we think industrials make a lot of sense, especially as infrastructure will continue to be built out here in the U.S. and globally. A lot of manufacturing is coming onshore across the globe. And so I think that'll be a trend that continues to play out in the next 12 to 18 months. Certainly areas like financials, which have historically been more levered to a better economy, could look to a period of better performance, but probably not till 2024, back half of 2024. And energy is the other part of the cyclical story that's already shown, better performance even in this quarter. Part of that has already played out, but I think, those three sectors and cyclicals we would continue to watch carefully. Think about consumer discretionary as well as we move forward.
Yeah, I was wondering about that. I mean, restaurants, airlines, hotels, luxury. How do you view the U.S. consumer right now as we get reports from places like, Darden, that its customers are choosing less expensive wine, although those aren't probably the same customers buying stuff from Hermes and Gucci.
Yeah, look, it's interesting. The consumer has been the backbone of this economy. They've been extremely resilient thus far. But we are entering this period. We're at the end of the summer travel season, and consumers are faced with not only higher oil prices, now an interest rate environment that may be higher for longer. And of course, we know they've worked down some of those excess savings that were given to them in the post-pandemic period. And by the way, credit card levels are elevated and lending standards are tighter as well. So this is, probably some headwinds to consumption in the consumer in probably the 1 or 2 quarters ahead. We'd expect a bit of softening, not only in the consumer, but we're seeing early signs of labor market maybe cooling as well. So areas that had really held up well, will the next move be, better or some softening? We think probably some easing is likely. And so that's something to keep in mind, especially as we think about, earnings and growth in the months ahead.
What about rates? I mean, 4.5% on the 10-year, more than 5.1% on the 2-year. I mean, really across the curve, you're getting a decent return, so that even if you don't see capital appreciation, which seems likely to me, you're still getting a nice coupon.
Yeah, Matt, you summarized it well. Look, with yields towards the highs of this cycle, In fact, of course, there is some intrigue in the shorter duration part of the market. Cash and cash-like instruments are giving an opportunity that we haven't seen really in recent history. But there is some risk there. If you're in a CD and you have to reinvest in the months ahead, you might have some reinvestment risk. You have to reinvest at a lower rate. But also you can miss out some of the interesting opportunities that are forming. And to your point, the bond space in particular, especially if we look at a little bit of a longer duration investment grade bond area, that could be really compelling. Historically, forward bond returns have been determined by where the current yield is. And current yields, as we know, are probably towards a peak. And you're not only kind of locking in these better yields for longer, but you have that chance, to your point, of price appreciation. If over time, the Fed not only pauses, they pivot lower, you really have this nice window for extending duration ahead of that move, to your point, price appreciation and locking in yields. It's a nice combination that you might be getting in the months ahead.
Mona, stick with us. Mona Mahajan there from Edward Jones. We're continuing to see breaking news come across the ticker on Ford. People familiar now telling Bloomberg News that the UAW is making meaningful progress with Ford. And of course, we're set to get an announcement from the union president at 10 a.m. on Facebook Live. And then he set a deadline for 2 hours after that. Let's get back over to Kaylee Lyons right now. She's in Washington, D.C. and has more for us on this developing story. Kaylee?
Well, Matt, you can see it moving the market already. Ford shares now up about 2.5%. If these gains hold, could be the best day for the stock going back to June on this news of progress being made with this one particular automaker. We will, of course, look for details from Sean Fain's live streamed event that is happening just about 20 minutes from now. But remember, there's still two other automakers at play here, GM and Stellantis, and we don't have news at this point of whether or not progress is being made on that front. So when we're thinking about the ways in which this strike could expand or not, which automaker could see more pain inflicted by the union. Ford shares, though, definitely benefiting from this news. Now, we did have a separate report also just moments ago from Reuters that the UAW was going to ask President Biden or invite him to come to the picket line. And this is really interesting, Matt, because, of course, as we've talked often about, President Biden has billed himself as the most pro-union president in history. He's come out on the side of the UAW workers, even though he says no one wants a strike. But also we have to consider that next Wednesday, on the evening of the second GOP primary debate, former President Trump is going to be counter-programming that debate by being in Detroit and addressing the UAW. So it'll be really interesting to see if we have the former president and current president, who right now are the front runners of each of their individual parties in the 2024 race, showing up at the picket line. But as for Ford in particular, right now up about 2.25%. We'll look for more details on that progress from Sean Fain just a short time from now, Matt.
All right, Kaylee Lyons there covering the developing strike story for us out of Washington, D.C., and obviously it's very closely related to the political story as well. So she's an excellent person to get updates from. Coming up, fresh economic data rolling in. We're breaking the latest U.S. PMIs after a little bit of a disappointment out of France and Europe. This is Bloomberg.
The committee left the additional rate hike this year in the dot plot. I think that may be a good thing to do as insurance to make sure that core inflation especially continues to come down. I think the risks are building that inflation could hang up at a higher level or even go higher based on the idea of a reacceleration in the U.S. economy.
That's former St. Louis Fed President Jim Bullard speaking yesterday with Mike McKee on the U.S. economy. Breaking PMIs crossing the terminal right now. Let's get over to our international economics and politics correspondent, who is actually sitting right next to me. There.
Yeah, not overseas, but we do have numbers both in the United States and overseas, and the U.S. is not Europe. We can say that. Global manufacturing on the S&P manufacturing index for the PMI, 48.9. That's up from 47.9, still a little bit below the 50 break-even point. But services and the composite for the U.S. remain above 50. 50.2 for services, 50.1 for the composite. Those are down a tick, but they do show still continued growth in the U.S. And that is a completely different story, Matt, from what we see over over in Europe. You take a look at France, Germany, the Eurozone, and the UK all reporting today those global, those S&P global PMIs. Look at all the 40s. There are no 50s there. And in Germany, rather, you see 39.8 for manufacturing. Germany, the only one of those countries at this point forecast to actually go into recession by economists surveyed by Bloomberg. But the UK very close to it. And of course, the Eurozone itself is struggling with manufacturing. You look at those numbers, and it is definitely not the U.S. We'll see what the Fed thinks of these numbers and what the Fed thinks of what the Fed did, because today we get a lot of Fed speak. The blackout lifts today. Lisa Cook is speaking. Mary Daly and Susan Collins are speaking. All this coming up after 10 a.m. this morning, and Neil Kashkari later this afternoon. So we will get some idea of whether the markets are reading the Fed right and what they decided the Fed is going to do after the decision on Wednesday.
All right, Mike, thanks very much. Michael McKee there, Bloomberg Television's international politics and economics editor. Mona Mahajan is back with us. And Mona, you know, what's your take on, I guess the PMIs here are pretty much in line with expectations. The French PMIs I saw disappointing, and Europe looks like it may be contracting. How does the economy look to you?
Yeah, you know, it's interesting when you look at the dichotomy between manufacturing and services. Of course, manufacturing had been in a downturn, and now we're starting to see a bit of stabilization, even a tick higher. And services, which had been driving, you know, the U.S. economy, looks like it's heading towards a peak. And so this idea of rolling downturns, or as some call rolling recession, could still be in play here. You know, parts of the economy that had originally really kind of gotten hit hard by the Fed rate hikes are starting to see signs of stabilization. You can maybe even put housing in that category, and services, which, you know, had kind of chugged along, may now start to stall a bit as we're heading towards these peak rates that finally, you know, may catch up with that lag impact that we've all been talking about. And so we do think that the U.S. economy could soften, but probably not, you know, heading towards any sort of technical recession, but a period of below trend growth. And even in the Fed projections, you know, the 1.5% for 2024 could imply a softer first half followed by a rebound in the back half of the year. And I think that to us seems like a credible backdrop.
In terms of next year, you know, so many people have been saying we're going to see double-digit earnings growth come back again. I guess you have to be in the soft landing camp to believe that. But if we do get sweet economic growth in the U.S., why do you think the Fed would cut rates twice? What's the catalyst?
Yeah, it's a great question. And, you know, look, I think with rates here, even at 5.25% to 5.5%, still highly restrictive. And if you think about inflation perhaps continuing to moderate, you know, even in line with their own projections, that brings the real rate, you know, the nominal rate minus inflation, even higher. Even if the Fed just, you know, keeps steady at this pace on pause, real rates, which do impact the economy and do add a bit of tightening, continue to move higher. Now, if they do believe that a neutral rate is closer to 2.5% to 3%, and if inflation continues to moderate, do they need to stay at such a restrictive level for an elevated period of time? And so I think over time, the way they would probably communicate it is they're going to start normalizing rates gradually back towards a neutral level. And so that could be where you get the signal of 1 to 2 rate cuts next year. We think that is a credible scenario. If the economy softens more than they expect, you know, the original scenario of 3 to 4 cuts may be back on the table as well. But for now, I think a normalization out of this highly restrictive territory is probably the path of, you know, most credible for now.
All right, Mona, thanks very much for joining us. Mona Mahajan there from Edward Jones. Let's get some sector price action this morning. For that, we go to Bloomberg's Abigail Doolittle.
Yeah, Matt, very quickly, we are looking at a rebound rally for the S&P 500. So we have more sectors higher than not, led by energy. Interestingly enough, we have some of the rate-sensitive sectors on bottom, such as utilities and real estate and healthcare. Even though rates are lower, those dividends should look better. That's not the case. On the week, though, let's take a look at the week. The S&P 500 right now heading to a decline of 2.5%, the worst week since early March. Here are the two best sectors. Defense, so that's risk off. And then the two worst sectors, real estate and consumer discretionary. Rough week for stocks, third week down for the S&P 500 in a row, Matt.
All right, Abigail Doolittle, thanks very much. Coming up, the market-moving events you need to be watching. That's next in our trading diary. This is Bloomberg. Bloomberg's The Open. I'm Matt Miller in for John Ferro. Time now for the Trading Diary, what you need to be watching through the next week. UAW President Shawn Fain making an announcement on Facebook Live. This coming amid fresh reports of meaningful progress just in the last 30 minutes in the UAW's negotiations with Ford. That announcement on Facebook Live at the top of the hour will bring you all the headlines. Plus, more Fed speak from Mary Daly and Neil Kashkari. That's at 1 p.m. New York time this afternoon. We get U.S. GDP next Thursday, plus more Fed speak from Goolsbee, Barkin, and Chair Powell. And finally, the government shutdown deadline coming at midnight on September 30th. This is Bloomberg.